Hello, good afternoon. You've tuned into your stocks on CNBC-TV18 and I'm Vinny Motiwala in the Mumbai News Studio. Let's look at what the market is doing. Nothing exciting happening there. Like last time we checked it, also 24,200. Right now also just trading around that mark, and 0.5% of decline is what we're seeing, but not much in terms of a recovery or any move on the upside that we're seeing for the markets. Nifty Bank, that too is under pressure, trading near the day's lowest point, and that's the top drag coming in today. So, pull up the Nifty Bank and the top contributors also that you talk about it in terms for the market. We have ICICI Bank, HDFC Bank, SBI, all of them are in the top drags for the contributors coming in for the Nifty 50. And that is why Nifty Bank is the top sectoral gainer. Banks not doing anything exciting other than that. L&T also among the top drags coming in. Some respite and green coming in for Reliance, but not much of an action happening there. Mid and small cap too is today under pressure, slightly bit lower than what the benchmark indices are seeing. Both of them are down almost 0.6% to 0.8% in trade. The Nifty mid cap as well as the small cap. So keep an eye out on that. That's how the market is shaping up right now. Nothing exciting there. Near the day's lowest point, trading around that mark. But let's get started because this is a show where we solve all your stock-related queries. And to solve all those doubts, today we have our experts joining in with us. We have Shahina Mukadam, independent market expert, as well as Soni Patnaik, Assistant VP Derivative Research at JM Financial Services, joining in with us this afternoon. Good afternoon, ladies. Thank you so much for joining in with us on the show. And Soni, I have to come to you. Markets, nothing exciting, right? Nothing exciting yesterday, nothing exciting today. What is it that we're seeing coming in terms for the market? What are the levels that we're watching out for? Today, it broke even the 24,200 mark. It was below that level at one point of time.
Hi, good afternoon, Vinny. Thank you for having me on your show. I think Nifty is below its 20 and 50 exponential moving average, and the important level that it had broke was around 24,400. So now the next level of support can be seen towards 24,000. Any move below that, and you can see it heading towards 23,800 as well. So I think it's gone into that selling territory as of now, and any rise can continue with the selling pressure. As long as Nifty is not crossing above its 24,400 mark, the sell on rise may continue. Stock specific wise, we can see a lot of stocks are getting hammered today, and that selling is just intensifying. So 24,400 is a crucial mark for any short covering move that should be seen in a recent move. Otherwise, we're heading towards 24,000 on immediate basis, where lies the next crucial support. I think similarly for Bank Nifty, which was holding on to its 20 exponential moving average, level of support yesterday, but today it broke. So I think Bank Nifty is also may drag the index lower towards 51,500. So that could be a crucial point to decide whether it bounces from there. But both the indices, as of now, have entered the selling territory, and any rise can, make it into a sell on rise structure.
Okay, sell on rise structure that is coming in for the markets right now. Thank you so much for that update there on the market, Soni. But on that note, we'll start with the stock-related queries. Let's move on to the first query for the day. We have this one coming in from Kalyani, who's writing to us from Mumbai, holding 5,000 shares of CG Power at a price of 225 rupees per share. So currently, obviously, the viewer is making a good amount of profit on this one. For them or for a long term, what is the view that you have on this one? Shahina, let me start with you. Should the viewer continue to hold this or maybe book some partial profit in CG Power?
See, I would suggest the valuations have become so expensive and the investor has made good amount of money. So he can take part profits. Take some profits home, but at the same time, the rest he can continue to hold for the longer term. See, valuations, if you look at it, if you see in terms of at the current levels, it is now turnover is like the market cap is 9 times the turnover, which is pretty expensive for a capital goods sector. Also, you have the overall P. In fact, all the other financial parameters are expensive on the terms of current pricing. So take some profits home. But in the longer term, the opportunity is huge. They are putting in investments in expanding capacity, and all this will come into fruition next year. So I think over the next 3 years, you'll see a good growth in revenues, and then the valuations will start looking more attractive. So to that extent, I expect some consolidation. Hence my recommendation.
Okay. So partial profit booking, the long-term story is good because of the expansion plans they have. Sony, on the charts and technicals, right? Like Shahina was also mentioning, valuations are expensive. The stock also, when you look at it, YTD last 1 year has seen a very sharp jump up and a rally that has come in for CG Power. So what should the viewer do on the technical front as well? Similar to what Shahina was saying.
So Vinny, on technical front, I think, since, she's holding out from a very low levels, it is wise to take some partial profits, trail the stop loss towards 650. However, the stock is a new entrant in FNO space. It has been building up good position. So there's a possibility that in the next 3 months or so, the stock can head towards 900. I think that's the range again where one can look to book more profits. But as of now, if 650 can be the trailing stop loss, then hold on for the targets towards 900, where you can actually make better and more profits to book.
Okay, that's the word coming in for CG Power. Let's move on to the next query, and this one is on a private bank. ICICI Bank is the next stock that we'll talk about. Priyanka Khanna, who's writing to us from New Delhi, 2,500 shares of ICICI Bank is what she's holding at a price of 955 rupees per share. Currently, the stock is trading at 1,311. Wants to know, for the long-term investment perspective, does ICICI Bank merit, to continue hold the stock, or maybe look to sell this one? What is your view on this, Shahina? ICICI Bank in the private banking side, is that a good bet to continue to hold on, given that she's already making a profit? So, if she looks to sell this, can she buy some other bank?
Well, ICICI Bank is part of my core portfolio, has been for quite some years. And I believe that even at current levels, it looked pretty attractive. If you see price to book, it's about 3 times. So I would put it on the fairly valued side for the shorter term. But for the longer term, of course, there's opportunity, because if you look at it in terms of growth, you see the first quarter itself, they've done pretty good growth. And they're likely to sustain over the rest of the year. In fact, even next couple of quarters. In terms of the PCR, the provision coverage is pretty high. They've got 79% coverage, which is good. Net NPA 0.4%. So basically, balance sheet is strong, growth is good. Private sector bank, it's got most of its its businesses in line and doing well. So I would say hold for the long term.
Okay, hold for the long term. And on the technical, Sony, ICICI Bank, how is that looking?
So when it continues to look strong on technical charts for a longer term perspective, 1200 seems to be a good support. So one can continue to hold with that support. I think on a monthly basis, we can see it heading towards the 1450 odd mark. So I think hold on, 1200 good support, towards 1450 to 1500, that range one can look forward to book profits.
Out on those levels over there. But now, moving on from a private bank, we have a query coming in for the public banking side, and we have it on SBI. Meera Vasudev, who's writing to us from Tamil Nadu, holding 3,000 shares of SBI at a price of 600 rupees per share, wants to know for the long term the outlook of the stock, and if she could continue to hold this or look to exit and get out of the stock and book their profit. Shahina, SBI, what is the view?
It's a hold. Valuations are extremely attractive. It's just about 1.2 times price to book currently. Also, if you see in terms of growth, they're doing pretty reasonably well. In terms of loan growth, they have grown by about 15%, deposit growth 9%. If you look at their return on assets, it's about 1%. I think that is factored into the low valuation that we're seeing as of now. So I would say it's a hold for the long term.
Hold for the long term. That's the view coming in for SBI. And Sony, on the charts, obviously today the banking names are not doing anything great, but SBI in the last 6 months also has been very muted. So, what does it merit in terms for the viewer to do? Hold, exit, maybe look to add some more. Is that also a strategy that would work out for SBI, Sony, on the charts?
So, Vinay, certainly I think it looks fine on monthly charts. 750 is a good support. It has been holding above that level, although in the past 6 months it has not outperformed its peers, but it has come out of its consolidation zone, which is above the 800 mark. So anywhere between 800 level on declines, one can actually add some more. It looks good. It's poised to take out its previous all-time highs towards 910 plus on a positional basis, of course. Maybe in the next 3 months, one can see it crossing those all-time highs. Any move above that, it can head towards 1,000 odd levels. I think it's wise to continue holding it. 750 is a good support. You can add some more quantity on declines and look for a 950 to 1,000 odd target to book the profits.
Okay, thanks for that view coming in on SPI. But on that note, viewers, we are going to slip into a very short break. But today is Wednesday, so after the break, we'll bring in our special segment, the Growth Code, an initiative by Grow and CNBC TV18. We'll address viewer questions on how to develop smarter trading habits, so stay tuned in for that. Welcome back, and moving on to our special segment, the Growth Code, an initiative by Grow and CNBC TV18. Whether you are new to investing or a seasoned professional, our goal is to provide you with insights and strategies you need to navigate the market and make informed decisions. Today, we'll address the viewers' questions and explore how traders can avoid common pitfalls and develop smarter trading habits. And obviously, we have our experts here today as well. Shahina Mukadam, independent market expert, as well as Soni Patnaik, JM Financial Services from the VP there as well. So yes, both of them are still with us to solve all those doubts. Thank you so much. And let's move on to this segment now. And we have Rahul Singh, who's writing to us from Bihar. And his query, and he says that he was invested in the market but finds himself overtrading due to the volatile phases. He's asking how traders are like him should recognize and control the behavior. What is it that they should be watching out for? Soni, let me take it to you first.
So, Vinny, I think this is a very live, real example that we're witnessing right now, the volatility in the market and how we can see the movement is happening. So in this case or this scenario, what one best can do is learn how to hedge the positions. Maybe, if you're doing it from a trading perspective or from a portfolio perspective, hedging works from both ways. And I think that's sort of a strategy works out best. So I think maybe, when it comes to the volatility or any sort of choppy markets or even event-based volatility that can be seen, hedging can help you to risk that volatility risk, and it can give you better confidence in holding out your positions. Of course, discipline holds out a key that when your stop losses get hit, one must exit from the trades. But of course, when you're hedging the position, it limits your downside risk, and you will have better confidence into holding the positions when it comes to choppy market.
Okay. And Shahina, what is it that you would advise our viewer Rahul to do? Because he's also asking in terms of how can one actually identify, in terms of volatility, so that he can maybe take a cautious step before as well.
See, the definition for volatility is if there's a huge fluctuation. So this is a huge fluctuation in stock prices, which actually you can have a couple of parameters that throw this up. Like, for example, you have the VIX. So if the VIX is higher, there is more volatility. You have also something like the Bollinger Bands, which you can look if you're doing technicals. So the broader the band, you can assume that, it's a bit more volatile. You have trading volumes actually which go up. You have beta, higher beta stocks. When there is a huge volatility, the stock movement is much higher than the overall market. So in times of high volatility, these are the stocks that you would probably need to avoid. In fact, when you feel that the market is becoming volatile, it's better not to, to reduce your trading. Also, do not be leveraged at such a time. There are some instances when you can expect volatility. For example, there is a huge global event, local event. So event-driven volatility is also there. So if you're trading, it is better to protect your capital by avoiding doing major trades in such a time.
Okay. Why is coming in there on that volatility and how one should be navigating that, what you should be doing. Let's move on to the next query. We have Shweta Tiwari, who's writing to us from Mumbai. This is a very common one because what she's saying is that she makes a lot of impulsive decisions during the market sell-off. I mean, more like I think it's a panic kind of a situation that is created for her. So she is asking that some strategy that one should follow to stay disciplined during this time instead of just panicking, making those emotional market moves. Soni, what's your view on this one, and what is it that you would advise the viewer?
So when you see any sort of a market sell-off that we see always comes in temporary phases. The only sort of help that one can have is to be disciplined, religiously disciplined, and exit the trades when it's going against the view or it has hit your stop loss. The other kind of strategy, like I've just explained, would be to hedge the positions to understand where, how longer can you hold on to your trading perspectives, or that horizon will just broaden for you when you're hedging the positions. I think these are some of the strategies. It could be from the derivative point of view, that one can actually buy a put option, sell a deep out of the money call option against the stocks that you're holding. There are multiple such derivative strategies and options platforms that one can actually adopt to hedge the positions. Otherwise, be disciplined, and when your stop losses get triggered, it's wise to exit from the position, wait for the market sell-off to happen. Even if a rebound happens, you may re-enter the position, but stick to the discipline of exiting the trades when the stop losses get triggered.
Okay, and Shahina, what is your view on this one? What should the viewer do? What should Shweta be following in terms of a decision to discipline herself at such a time?
Before making any investments, you need to have a clear plan in mind. You need to know what you're investing for. You need to know what is your risk appetite. For example, if you're looking to make, this money is only to be invested for a short time, medium time, or you want to have a long-term investment. So basically, once you have decided that, then I believe you can actually fix targets. For example, look at fundamentals of the particular stocks that you're doing. Or even you can also have a systematic plan for mutual funds. So basically, systematically plan your investments based on parameters which you have pre-decided. And then I would say that unless there's some major change that has happened in that particular stock or fund, then you keep to your targets of the targeted price that you're looking at based on fundamentals, technicals, or the stop losses. So be disciplined.
Okay, be disciplined. Let's move on and to the next query. We have Ramesh Jain, who's writing to us from New Delhi. He says that he risks too much of his capital on a single trade and has faced significant losses because of that. Now wants to know how he can determine the right position size to minimize his risk. Shahina, what would your view be on this one?
I would say, however small your portfolio, you need to have, in my view, at least 5 to 10 stocks if it's a very small portfolio. Also, in terms of sectors, it's better to have a percentage maximum allocated to a particular sector. Also, you do need to look at various other parameters, but I think in these, if you stick to this, at least you're minimizing your over dependence on one particular stock or sector, and to that extent, you will for the medium to longer term, you will minimize your risk.
Okay, and Soni, what is your view on this one?
So first, I think, Vinny, one must understand the risk-reward ratio in any sort of a trade that the person is getting into. And, technically also one can understand where the support and resistance lies for the stock. So that will help you understand how much potential of an upside you have when you're entering the risk, and how much of a downside risk are you letting lose your capital out on. So I think that these are some of the important measures. As already discussed, stop losses work as a very good way of exiting or helping you exit the trade whenever it goes wrong. I think these are the key disciplines to follow.
Okay, let's move on to the next query. We have Rupinder Singh, who's writing to us from Chandigarh. Now, he says that he has the tendency to chase hot stocks or sector-specific stocks and asks how he can distinguish between sustainable opportunities and mere the market hype. Shahina, what would your view and advice be for Rupinder?
Yeah, the biggest problem in our market is FOMO and, greed and fear. These are the important factors that you have to be mindful of when you are investing in the equity market. So what I believe is that, a lot of hype is sometimes created over stocks which do not have much fundamentals backing them, where the managements are actually maybe interested parties. So to that extent, it is better to actually look at the fundamentals. Do not be carried away by the hype if there is not much fundamentals to a particular story. If you're a new investor, it's better to stick to the mid and large cap stocks, which are more widely covered, so you get a hang of the fundamentals. So I would prefer that if you're just starting off, it is better to play safe. Invest for the medium to longer term. Mutual funds is another aspect which you could look at if you're starting off.
Okay, let's move on to the next query. This one is from Priyanka Mehra, who's writing to us from Mumbai. She wants to know the tools or methods that can be used to test the trading strategies before implementing them live. Soni, what is your advice for this?
So Vinay, I suppose that there are tools and live softwares which can help you understand how to trade or do some sort of a paper testing. I'm not aware of such tools, to be honest, but perhaps the simplest way and non costly way could be that you try it out on paper testing. However, it is also important to understand and realize that when you're doing something as a virtual or a paper trading, and when you are doing it in the real scenario, and seeing the live prices move or due to volatility or any sort of a scenario comes in, that's going to be a very different game of play. And it's a new day brings in a new opportunity, and every day is different. So regardless of how much practice you may do it in virtual or paper trade testing, when you come it out on real life, I think that's going to be very difficult, because days like today, especially when volatility is so high, it gets difficult. So I think it's get out on that, and just you can play it
Sure.
out and understand how to go about it.
Okay, that was the last query for today. Thank you so much, Shahina, as well as Soni, for joining in with us and solving all our viewer doubts. But with that, we are absolutely out of time on this edition of Your Stocks on CNBC TV 18. Thank you so much for tuning in.